Laying the financial groundwork, streamlining bank accounts forms the bedrock of financial flow. Selecting the right options, refining their use, and sidestepping hidden costs. The effort takes mere hours to establish, and once in place, the system runs smoothly with little oversight. Yet lurking pitfalls exist. A familiar account at a traditional bank might silently siphon funds through fees or rigid rules. Conventional institutions often view newcomers as opportunities, banking on unnoticed charges or overdraft penalties. Armed with awareness, those traps can be avoided, maximizing gains while minimizing expenses. How banks build their profits. Banks thrive by leveraging deposited funds in a calculated dance. Picture $1,000 placed in an account. A typical traditional bank offers a scant 0.5% interest, barely noticeable, while lending that same amount at 7% for loans like car financing. If repayments hold, the profit margin swells, a shrewd operation reaping rewards while depositors see crumbs. Risks of defaults exist, but the spread between interest paid and earned remains substantial. Fees amplify the haul. In a year like 2008, overdraft penalties alone generated billions for banks. A debit card swipe exceeding the balance doesn't get declined. Instead, it's approved, followed by a steep charge, sometimes $25 or more. Multiple fees can stack in a day, with penalties escalating after the first. Websites often obscure these costs behind dense terms and glossy distractions, rarely highlighting the true toll. Escaping the fee. A single overdraft fee can wipe out a year's interest and spark frustration with banking systems. More than half of people encounter this snag at least once. For someone like a college student, losing track of funds might lead to hundreds in penalties over years, avoidable with a quick bank call to waive initial charges and set up alerts. Fees often dwarf interest earned. A 1% rate boost on $1,000 yields $10 yearly, while a $30 overdraft hit erases it instantly. Minimizing costs outweighs chasing tiny returns. Online banks disrupt this pattern. Free of physical branches and their overhead, they cut fees and lift interest rates, sometimes to 3% or higher, far surpassing the 0.5% of traditional banks. Lean operations pass savings to users, and some even deter high-maintenance clients to keep expenses low, a contrast to traditional banks that push premium add-ons. The result? Online savings can yield 8 to 12 times more than their brick-and-mortar counterparts, turning idle cash into a modest builder, backed by federal insurance up to $100,000 for security. Understanding account essentials, the foundation, rests on two pillars: checking and savings accounts, each with distinct roles. Checking accounts. These serve as the hub of daily finance. Funds flow in via deposits and out through debit cards, checks, or transfers. They handle routine costs like bills or subscriptions, often linked to cards, though some expenses, like rent, draw directly via automated systems. Traditionally interest-free, newer online options now offer small returns, blurring lines with savings. Fees, however, lurk most here. Attention keeps them at bay. Savings accounts. Designed for goals, short-term escapes, or longer-term targets like home deposits, these accounts act as a steady vault, accruing interest as funds grow. Traditional banks offer a paltry 0.5%, where $1,000 earns less than $5 yearly, eroded by inflation's 3% bite. Online alternatives deliver 2.5% to 4%, generating $25 to $40 annually on the same amount, growth that compounds. The trade-off? Access. Takes a few days, requiring transfers to checking, ideal for those who rarely tap in. The dual advantage. Separating checking and savings isn't mere organization. It's deliberate design. Checking manages spending. Savings fuels growth. Funds not in checking stay out of reach for impulse buys, preserving bigger plans without delay excuses. Even modest sums, like $200, benefit from this split. Early habits pave the way for larger successes as balances rise. Crafting an efficient flow funds might enter through an online checking account earning interest, fed by payroll or mailed deposits. A local account may linger for convenience, though it's less vital once digital systems take hold. Monthly, money splits automatically. A portion to high-yield savings, another to investments, and bills clear via a card tied to checking. Cash. Withdrawals lean on an ATM card with fee rebates. Savings remain untouched unless bridging a gap or funding a milestone. Tailoring the approach. No universal blueprint fits all. Needs differ. 3 paths stand out. Minimalist setup. A. Local checking and savings pair. Basic and straightforward. Ensure fees don't creep in. Balanced strategy. Combine a no-fee local checking with an online high-yield savings. Quick access meets meaningful returns. Confirm costs, stay nil. Optimize system. Multiple accounts across platforms. Chasing top rates and perks, like local checking, online interest checking, and separate savings. Potent but intricate, requiring coordination. Sorting through choices options can overwhelm, akin to a bustling market with endless offerings. Clinging to an outdated account misses better prospects. Credit unions offer a compelling alternative. Member-owned, they prioritize lower loan rates and personal service, open to most via broad eligibility. They merit exploration for both accounts and borrowing. Banks tier their products. Student accounts waive fees, mid-level ones tie perks to deposits, and premium tiers demand high minimums for inflated benefits. The latter rarely justify their cost. Stronger yields lie elsewhere. Choosing wisely. 3 principles steer the decision: reliability, simplicity, and reward. Favor banks with transparent terms, round-the-clock support, and no clutter of promotions. Seamless transfers and accessible help enhance usability. True value comes from strong rates, free services like bill pay, and practical extras, not fleeting incentives. Pitfalls to avoid. Temporary high rates that drop soon after. Minimum balances locking up funds for free features. Aggressive pitches for unneeded premium accounts. Claims that fee-free options don't exist. They do, with persistence. Bundled extras like credit cards that add no benefit. Standout options. Checking. Local no-fee accounts or online picks like Discover Cashback Checking. 3% interest, no fees, ATM refunds. Savings. Ally Online. Savings, competitive rates, goal-setting tools, no minimums. Refining the system. Whether new or long-standing, accounts need adjustment. Fees are the foe. Eliminate them entirely. A firm request to a bank representative. Make this no fee, no minimum. Often works, especially when citing competitors or the cost of losing a customer. Overdraft charges can be negotiated away with a clean record and a courteous ask. This was an oversight. Can it be waived? Most relent with escalation. For students, fee-free accounts are standard. Insist on them. Small disciplines now, like dodging a $5 monthly charge, fortify future stability. Steps forward. Audit checking. 1 hour. Open or review an account. Ensure it's fee-free, pushing back if needed. Activate savings. 3 hours. Launch a high-yield online savings and deposit funds. Explore online checking. 2 hours. Consider an interest-earning option if desired. Allocate funds. 1 hour. Keep 1.5 months. Expenses in checking, shift the rest to savings. Even a small start counts. With accounts aligned, the financial spine strengthens, primed for the next leap into investments.